Hey guys, so today we'll be going over Monte Carlo simulations. We're going to try and run simulations on the SPY ETF, and we're going to try to predict SPY's closing price each month. Hopefully I didn't forget any packages, but for now we'll just run these two, and then we're going to start with the ticker. So we're going to call it in SPY. I'm going to get some data from Yahoo Finance. So we use get symbols, ticker, auto assign false. So we'll run this line here. We'll take a look at the bottom of data here, and today's date is June 10th. So to compensate, I'm gonna call in today's data by using get quotes, ticker, and I'm going to bind our data with the latest quote. Use open, use the high, low, last, the volume, and then last again, since it has an adjusted column. Then we're going to order by today's date. So we'll run this. Now we have today's data there. Next, I'll store the adjusted prices here. So that we can calculate the returns. And then any A's, I'll replace them with 0. So our mean and standard deviations for the history of SPY since 2007 is close to 0, and the standard deviation is almost 1.3%. Alright, next we're going to build a function where we pass in the stock price, the number of periods we want to predict, the mean, and then the standard deviation, and then it's going to return the predicted price. So we'll use stock correct here. So we're going to pass in the stock price, the number of periods we're trying to predict, the mean, and then the standard deviation. So this is for one period. These are just random probabilities. So we use from 0 to 1. We're going to use Q norm, pass in our probabilities, the mean, and then a standard deviation. And then finally just return the stock price. So we'll run our function here. So the latest quote for SPY is 319, which is its close price on this day. I'm going to run 1,000 simulations. The number of trading days is set to 20. Since we're using today's mean and standard deviation, I'm going to look back 20 days to see the predicted stock price for today. So that's today's date, minus 20 days. Let's see what that price is. So we're going to store the mean here. Now we're going to run the simulation. I'm going to create an empty vector to store all the prices here. And then we're going to use our function that we created. We'll take a look at stock prices here. So here are the predictions for today's closing price. So create a summary here using quantiles. So here it's saying that the lowest possible stock price for today would have been 283.56 and the highest would have been 306.72. But if we take a look at our temp, today's closing price was 319, which is way higher than the 100%. And this happens because we're using the mean and standard deviation to predict future prices. And as we know, the mean and standard deviations are not static and they constantly change. So when there's periods of volatility, these numbers may be off, but when the prices don't fluctuate and stay static, so does the mean and standard deviation, and prices remain within this range. So now I want to see the predicted prices every month, and I'm going to test this from 2007 until present. So let's clear here, and I'm going to use options expiration dates. So to extract that, we'll just subset temp to options expiry from quant mod and use temp. So then if we take a look at our expiry, these are all of the monthly options expiration dates along with the close for that date. So what I'm going to do is try to predict the following options expiration stock price for each of these. And we'll use everything after 2007. Extract the index. The next expiration date is June 19th. Here I'll combine IDX with next expiry. So since our means change, I'm just going to use the available mean, and I'm going to calculate that by passing through the date, and I'm going to calculate the mean up until that date. And I'm going to do the same thing with the standard deviation. So calculate until so here we'll subset temp. Up until that date. We use ROC to calculate the return. And then if there's any NAs, set those to 0. And then finally just return the mean. I'm going to copy this formula. I'm going to do standard dev. Same thing, except I'm going to change this to st. Run these two functions. Alright, so now I'm going to calculate the means and standard deviations for each of the options expiration dates. So I'll do means, do call. I'm going to rbind everything. I'm going to pass in the dates. Here's our function. We'll run that. Standard deviations. Now we need the number of days to predict, so I'm going to calculate the difference of days in between the options expiration dates. So I'll use this days as numeric. Difference is expirations. So now I'm going to write the Monte Carlo function, and I'm going to pass the number of simulations, what iteration, and then if it's the last iteration. So I'll use Monte Carlo. Simulation, iteration. And then the last iter here is just for it to know when to stop the simulations. So here I'll list my parameters. Simulations. N is equal to the number of days for that particular iteration. Stock price, set that as numeric. Expiry, subsetting only that iteration. The mean will be means for that iteration, and the standard deviation is the same thing. Now we'll do the simulations here. So for I in sequence of simulations, we're going to run the following. Great. Since I'm going to make a nice data frame out of this, I want to store the opening price and then the closing price so we could later compare, along with the probabilities of where the stock price should be for that particular options expiration date. So we'll start with the start price. We'll store that as a data frame. Round that to 2 decimal places. What the start date was. Our probabilities. So we'll transpose the table, round it as well. Our probabilities is a sequence of 0 to 1 separated by 5%. Round that to 2 decimal places. Since these were prices, transpose and save it as a data frame. Now if the iteration is the last iteration. But as data frame, I'll put an NA there. Same thing for the end date. Otherwise, we'll do the following. We'll set the end date as a data frame, as numeric. Iter +1, run that to 2 as numeric, save it as a data frame. So that'll be our closing price. And for our end date, we'll do index, expiry, iter +1. Next, I'll combine everything. So I'll do start date, probabilities, the end price, and the end date. And then I'll rename the columns. So I'll use start price, start date, and then the probabilities separated by 5%, the end price, and then the end date. And then just finally, just return that data frame. Before you run this function, please add this line here for stock prices. We're going to reset the stock prices every time. So we'll run this function. And then I'm going to add a progress bar. So now we'll store everything in P. PB will apply. Let's list 1 through the length of our days vector. And we're going to pass in the function. So for simulations, I'm going to do 10,000. Our iterator is going to be X. Last iterator is going to be the length of our days vector. So we'll save it and then we'll run this. So not too bad, approximately 3 minutes. I'll come back when this is done and we'll continue. Alright, so now that it's finished running, I'll rbind everything. So I'll use do call rbind. Let's take a look at our data here. So we have the starting price for our starting date for each option's expiration, our probabilities of where the stock will be for the next option's expiration date, the ending price, and then the ending expiration date. Great. I'm going to plot the ending prices along with the probabilities of 0 and 100% and see if they pierce through those values. So we use P equals ending price, type equals line. So plot that. Then we'll add some lines here. So the 0 probability, color equals red, and then lines, probability of 100, color equals with the green. So we'll add these two lines. So since 2007, it looks like we have a few values that did pierce above and also below our threshold levels. So the number of months is equal to the number of rows. which is 158 months. We'll store that here. And then we'll do number of times it closes above 100%, which is equal to the sum of the numeric count, do an omit, if else. So with B, ending price is greater than 100%, set that equal to 1, else 0. So I went over 14 times. We'll copy this here. And then the number of times it closed below 0 was 16 times. So as a percentage, it closed above close to 9% of the time, and it crossed the below roughly 10%. All right, so you can always write this table as a CSV. To analyze later. So ideally, the price should stay between the 0 and 100% mark here. But as we know, the mean and standard deviation constantly change. So that's why we have some times where it'll pierce below or above the threshold, as we are right now, since the closing price was $319. So on May 15th, we started with a price of $286.28, and it was predicting a high price of $301.04. But as you see, it appears right through it, but we still have a couple more trading days left. But it's a nice way to make an educated guess of future prices. And maybe if we use shorter time frames and not go so far as to a month, maybe a week or even a couple of days, I think this model will be a little bit better. So again, thanks for watching, and I'll see you guys in the next video.